All right, I got the text. What do I do now? Okay, now this is from, if you've watched any of my other trading videos, this is from a friend who has a bit of money, and a few months ago they said, I got a bit of money, I want to invest it, what do I do? And first things first, I am not registered as an investment advisor, so first thing I said to her is, I'm not registered as an investment advisor, this is not advice. What you can ask me is, what would you do? So it's not advice, it's just kind of my story, entertainment only, all that kind of thing. Anyway, let's get to the point, you get the idea. So, not everyone can go to a financial advisor, they cost money. So anyway, got through that. A few months ago, I said, well, if you're busy, lots of things on, you buy some S&P. That's what I would do if I was you, but this is not advice. And so they went away and they bought S&P, right? And now they've, obviously, markets, let's call it what it is, market has crashed. And now she said, what do I do now? Do I sell? Whoa. You definitely do not sell. Definitely. Why? Why wouldn't I sell? The world's collapsing. And as we've learned from our other friend, as soon as they were down, I think they lost a few percent. They closed it out because they couldn't cope with the the loss they were seeing on their investment. Anyway, so this person now has more money because it's been a few months and they've earned some more money and they've got some more cash. And so she was happy with the don't sell. She's like, oh, okay, yeah, that's cool. She's like, do I buy more? Right. So, and then she said, actually, I'm going to wait for the bottom. Now that's a new person talking, because if you knew the bottom, you would know the top. And if you knew the intraday bottoms and the intraday tops of the stock market, you'd be a gazillionaire. So without trying to whip the rug from underneath her, I was like, she's like, when's the bottom? I was like, well, everyone wants to know when that is. But what we can do is take what the market is trying to tell us and give ourselves some chances. That's what we're looking for. So I've been doing this game decades, 30 years, 40 years. So I've lost so much money that hopefully I've learned a few things that I feel is important for me to communicate, not only to my friend who asked me, but because she made me go about answering her, I thought might as well stick that in a video. So I'll just take you through what I look at, and might be helpful, might not. Again, this is just entertainment only. All right, so the first thing I look at is the VIX. This is the fear index. And through history, so this is 2020, okay, so COVID had the fear spike because we all thought we were going to die. So that was the bottom of the market when everyone was the most afraid, because everyone just sold everything, just in pure fear. And then we had this marker here was the yen carry trade fear spike. And then right now we've got the Donald Trump tariff fear, where everyone thinks that the world economy has come to an end. So just when you look across these peaks that mark the bottom in the index, we have one right here. And as outliers go, this is an outlier. So yesterday, as the market closed, as she was talking to me, we were seeing this peak. So that at the open, the fear was at its greatest, and it gradually, fear became less as the day went on. So in terms of the fear index, can we be more afraid? Yeah, we've seen 80 before, but as things go, this is well in the realms of an outlying move. So to me, your probability of this being a market low is, I'd say, greater than 50-50. Now, let's tie that in to the most important index there is, the S&P. Now, ignore all the rainbow colors. That's all nonsense. Looking back to 2020, so here is the drop, the COVID drop, where we went from 340 down to 218. That's a big drop. We then saw in 21, well, it just started at the beginning, that the high was basically on the first day of the year. We then staircased lower by that amount. Now, do you notice the difference here? So COVID was a crash. This was a staircase decline. And then we're up here now. This one, so we had a rapid decline by a short rally over the course of a week to then that crash dynamic where we saw 570 in the index down to yesterday a low of around 485. That's crash territory, just that massive decline really quickly. And with that came that spike in the VIX index. Now notice, there's your spike in VIX was right here at the bottom, and since then it's gone up. Your yen crash, wherever that low is, one of these two markers, has since gone up. What do you think, given history, will happen? Our vol spike, our crash, our S&P will then go up? History would suggest, like if we scroll back in time on this chart, back then, can we go to 2008? Here we go. So 2008, over the course of these months, we had decline, crash, and then further declines. Over the course of time, this was a massive decline and a huge destroyer in wealth. But over time, the market recovered. It's the same. The 1930s, you name the crash generation, we are now at higher prices. 1987, 2000, 2008, 2000, you know. So if we are to believe that the world will continue as it is, just getting back on my chart, it would suggest that that vol spike is a low. So what have I done? Well, as we've crashed, I've bought, and because I've gone through it in previous videos, when we have been at all-time highs, I have been in more and more of a cash position, so that when this happens, I buy into the market. Think of it this way. If you went down to your local supermarket and everything was at a 20% discount, would you go, oh, I'll just wait for it to like recover a bit? You wouldn't. You would go around the store and you'd buy 3 times as much, 5 times as much. The stock market is no different, but people think it is. So right now, all these companies are at a 20% discount, some even more. Tesla's at 50% discount to what you normally pay. So in a normal world, if that was down at if you went down to the corner shop and a Tesla car was half price, you would buy 5 of them. If you went down to the store and your Nike trainers or your Lululemon pants were at a 50% discount, you'd buy 10 pairs. This is no different. This situation is no different. So for me, and they may get cheaper. I'm not saying they won't get cheaper. And I'm not saying these stock prices won't get cheaper. But as things go, as the opportunity presents itself today, down at the corner store where your Nike, your Lululemon, your whatever it is 30%, 40%, 50% cheaper, you'd buy a shed load. And that's what I'm doing. And that's what I said to her. It's as simple as. Now, if you were fully invested at the highs, all you can do is limit your losses. Now, how do you do that? Well, if you're fully invested and you're not on margin, you can just sit tight and maybe think about ways in which you can free up some cash to buy at these better prices. If you're leveraged, you would have already had to have de-risked to sell out some positions. But what I fear happens so often is people lose more than they should, and then they never return. They never come back to the opportunity that presents itself here. And for me, every crash marks an opportunity. I've been in the position where I've been over leveraged and had to crystallize losses, but I've come back to the market. I've never actually blown out an account, have I? I don't think so. I've been going for so many years, it's hard to remember. I've always been very risk averse, and I've pressed on it, and all my trading videos, your risk of ruin. It's more important than when you buy, when you sell. It's more important than anything, knowing your percentage chance of ruin. And it must be, if it can't be zero, nearly as close to zero as it can possibly be. So, for example, you don't put all your eggs in one basket. You minimize leverage. People talk about stop losses. When the market gaps down, your stop losses are useless. So it's your trade size at entry that is your real stop loss. That's the real thing that stops you from hurting. Because when you get a gap down, and across Asia, they hit circuit breakers, so you couldn't trade anyway. It's being able to come back tomorrow. And I don't want to talk about me. It's knowing, always think, if the market crashes tomorrow, how's my portfolio? If the market crashes over the course of the next year, let's say Trump holds strong on his tariffs, China holds strong on the tariffs, and let's say global trade decreases by 20%. The market will go down because there'll be less profits, less revenue, and less earnings per share. So over time, we will recalibrate to this new world. And maybe this is the high in the market we'll never see. For example, and don't think I'm joking, the Nikkei for 25 years didn't make another high. So we're 2025. 2050 could be the next high in the S&P if we were to follow the history of the Nikkei. That let me see if I can show you it. Right, so this is an astonishing chart. Here's the Nikkei. November 1989. Here. It has taken 35 years for that stock exchange to get back to its high. Now, I'm not saying that's going to happen to the S&P, but I'm not saying it's not going to happen to the S&P. So never, I hate people that say, oh, it always does. No, it doesn't. You can't rely on that. So for me, you buy into downs, sell into ups, to rallies. That's all you can do. And never, let's say this never peaks now for 35 years, doesn't go past that top. So you've got to be prepared. And I know that's totally crazy, but it happens. So anyway, so all we can do is when we go down to the store is we buy our Nike stock, our Lululemons, our whatever it is, whatever floats your boat. They're all at a discount. And all you can do is buy into it because the fear index was at an extreme. The market has crashed. History would suggest that this is a buying opportunity. And that's exactly what I said to her. Just to step into some stocks, because of the tariffs, Apple, for example, has been decimated. A high of 260. We're trading at 180. Amazon, these are your mag stocks. A high of 240. We're now trading at 175. Palantir, a real favorite in the recent bull run. Actually, it's held up very well. 120, actually, no, it hasn't. Percentage terms, it hasn't. 122 highs, trading at 77. I mean, just throw a dart, because all these stocks have been ravaged. Meta, traded at 730, now at 516. Tesla, everyone is trying to kill Tesla. 478 highs. We're now at 230, more than 50%. When you go down to your corner shop, your Teslas are at more than half price. Would you buy? Or would you go, no, I'm going to wait for it to be a bit cheaper? You're going to buy, right? You're going to buy 10 of them. You're going to buy 10 of them. It's no different in the stock market. Just a little look at gold, because everyone's loving gold right now. It has sold off. So from a high of 288 on this GLD index, we're now at 273. Not much. They're still penciling in inflation. Up on some boxes here. They mean nothing. Don't read into it. So that's where we're at. That was my answer to her. What do you do? That's what you do. If we go down further, what will I be doing? What would I do if I went to the corner shop? I'll be buying more. So and at some point, you're right, I'll run out of cash. Yeah, and that will be the case. But until that moment, if we get another 10% decline, I'll be buying more. But as we rally, I will be selling. It's the only way I find it possible to make money is buying into the dips, selling into the rips. That's it. I hope that helps. I thought it was really important to get this out because when your friends text you, it means there's a question to be answered. That's it.